Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. We've spent some time talking about the three financial statements and just kind of like point in time today, trying to come up with some vocabulary for like what's going on in these businesses. And so I want to start with like a little bit of a thought exercise. I want to ask you two questions, and I'll give you guys 30 seconds to think about it. We've talked about a lot of metrics, revenue, free cash flow, EBITDA, EBIT, net profit. What if I gave you a crystal ball and only for one of these line items? And you tell me like, Craig, this is the line item I want to know the number for the next 100 years. And I will tell you the future value of that line item for the next 100 years, but only for that one line item, and you only get to pick one. And I'll give you these options. I'll give you revenue, EBITDA, net income, free cash flow, and cash balance. I'll give you cash balance too. You get one. You get to pick one. And I'll tell you the value every year for the next 100 years, but I won't give you any other information about the company. Which one would you pick and why?
I want to say for me, I would want to know EBITDA, because from that I can kind of just project the profitability of like the whole operation. So then I could like adjust things accordingly if I knew like what it was for each year.
Okay, so you have chosen EBITDA, and so for the next 100 years, I'll just tell you this is the EBITDA number every year for the next 100 years. Blaze, what do we think? Same or different?
Yeah, I'm leaning towards EBITDA as well.
Okay. And so do you remember when we were talking about the benefits of EBITDA? So this is before some stuff. And you've made a decision that you don't care about what that other stuff is. So I'm going to argue that you picked wrong, in part because maybe you picked this EBITDA, this great, super high generating EBITDA business that operates in a country where they have 50% taxes, and this company that has all this EBITDA has billions and billions of dollars of debt, and they're paying 12% interest on all of that debt. And they spent all this money last year on this like factories. And basically I'm painting a picture of something that you might have the most EBITDA positive business in the world. But if you have billions and billions of EBITDA offset by billions and billions of interest expense, and you also have, you pay a 50% tax rate on whatever meager change is left after all of your interest, I would argue that you don't have such a great business. Or at least the value to you as a shareholder is limited. So let's guess again. What else might help? What might be a little bit closer to, the truth or the number?
What about net income?
All right. So now if we have billions and billions of net income, if you have all this debt, you have all this interest, you have all this taxes, that's taken into account. So if I told you the net income number, you're like, Craig, like, I don't care what the tax rate was, because if it was really high, then we made even more money to still get to the net income number that we made it to. But I get to recognize revenue when a transaction takes place where I deliver the good. It happens all the time in business that when you recognize revenue or when you process a sale, there's a lag or a lead between when the sale occurs and when you actually get the money. So think about this as an example where you're running a lemonade stand and you decide to sell lemonade to somebody who says, hey, I don't have the money for you right now, but I'm good for it. I'll pay it to you tomorrow. In accounting world, we actually recognize the profit for the sale as if they paid you all the money up front. And we have a line item on our balance sheet that's called accounts receivable, which basically tracks all of the money that you're owed for something where you've recognized, the profit, the P&L impact. You've already recognized the revenue, but you just haven't received the cash yet. So if the number that you told me, or the number that you asked that I gave you, I wave my magic wand and I give you net income every year for the next 100 years, over the course of 100 years, you're going to get paid these receivables. But where I'm going with this is there's one metric that's even better for this crystal ball exercise than net income, and it's free cash flow. Because what free cash flow will tell me is not only how much am I cumulatively getting paid, but it tells me when I get the money. And so the differences over the course of 100 years between net income and free cash flow, one of the biggest and most common is this receivables balance, where you might structurally always have a large receivables balance, where the more money you make, the more money people owe you but haven't yet paid you at any given point in time. And so understanding your free cash flow over those 100 years gives you even more insight than net income. Let me ask you a slightly tweaked version of that question, which is the crystal ball is gone. Now you get one number for this year to predict next year's free cash flow or the year after's free cash flow. Because at the end of the day, the reason we do all this work is if we had our crystal ball, we'd know what the free cash flow is for the next 100 years. And now I want to know today what gives me the best method of predict. Like if I only get one metric, and there's going to be limitations to every metric, but for this case, you only get one to try to predict next year's free cash flow. Which one do you pick?
I want to say net income.
Why?
Because in order to estimate, I guess, see the impact of the free cash flow in a year, we need to know what our net income was for that period of time.
In my opinion, the answer to this is it depends. And there are two good answers, I think, to this question, depending on the type of company you're dealing with. But to work backwards, if what we care about is free cash flow, then I want to start on the cash flow statement. And I want to focus on the three components of the cash flow statement: cash from operations, cash from investing, cash from financing. Cash from financing is in some ways not helpful to predict, because if you own the business, you're making the decision to give financing to the business. And if you do decide to provide financing to the business, like basically if you decide to borrow money or give away equity to get money, there is basically an even trade-off there, right? Like if you're borrowing money, then your cash from financing will be very positive, but also like you'll have to pay interest, and at some point you'll have to repay the money. And so I would say cash from financing is not only hard to predict, but it doesn't really create value for you. Or whatever cash comes in the door next year will go out the door, in the future. So I'm not really worried about cash from financing. Cash from investing. CapEx could be an important lever here. Like if structurally the business always has to buy new factories or always has to upgrade equipment, knowing that is helpful. But if you knew that there was structurally always CapEx, then there also will structurally always be depreciation of the assets that you've invested in. And that will show up on your income statement, and it'll show up in net profit over time. So CapEx matters, it's important, but I'm going to move past it. Let's talk about cash from operations. The biggest driver of cash from operations is net income. So Olivia, if you are thinking about investing in a public company, I think that net income is a great metric to look at to try to predict next year's free cash flow. Because that will include all of kind of like the ongoing standards of business performance. And so I think that it is a, it takes into account like the tax rate of the tax regime of where this company operates. It takes into account how much interest they have today. It takes into account their revenue and their cost. And look, you'd love to know about the growth too, right? Like you'd love to know if this was a company that, where revenue is going to be flat in a year versus if it's like doubling every year, right? Like you care a lot about if this is, the future of innovation where it's growing and growing and growing versus if it's like some stagnating thing. But I only gave you one. And if you picked growth rate, then it could be growing from a base of $0 or it could be growing from a base of like $1 trillion. So if you're looking at a public company, I think net income is the right answer. And by the way, so does like the world. Like the number one way, if you look up the stock ticker of a publicly traded company, the most popular valuation metric that you'll see is called the PE ratio, which stands for like P/E, which is calculated as the price per share of that stock divided by the earnings per share that stock produces. You can also take the shares out of it, and it's just the equity value of the business divided by the total earnings of the business. And earnings is the same as net income. Like EB nothing is just earnings. That's net income. That's profit. It's all different words for the same thing. In a scenario, though, where you own 51% of the business or 100% of the business, you have this special power where you can make the company do things. And so it is within your power to change things about the business. For example, you could refinance all the debt and make the interest go to zero. You could change where the business is located and potentially where it does business in a way that impacts the taxes that you pay. And you could also change how you capitalize the business and maybe change, the value of certain balance sheet assets that might be depreciating or amortizing. And so EBITDA, I think, is the other appropriate answer to this question. EBITDA and net profit are both very good predictors of future performance. People like EBITDA in the context where you're buying the whole company, because if you're buying the whole company, then you really care about the core operations of the business a lot more than you care about like decisions like how much debt the old guys were borrowing, which impacts your interest expense. And so EBITDA and net income, depending on whether you are a controlling owner of the business or not, are really like the two metrics that people look at. And so the other like key valuation ratio that people look at besides PE ratio, which is very common for public companies, is something called EV to EBITDA. EV stands for enterprise value, and it's reflective of not just the equity value of the business, but also the value of the debt in the business. It basically looks at who all your investors are, not just the equity holders, but also the debt holders who you owe money to. And it divides whatever that total is by EBITDA. I'll put a pin in that discussion, but that'll be kind of like the kickoff for where we resume our valuation work, because EV to EBITDA and PE are two very important ratios that people look at. And I hope that motivates why people care about them, because EBITDA and net income are big predictors of future free cash flow. They're better predictors of future free cash flow than even this year's free cash flow.
That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.